The Frank G. Zarb School of Business and WRHU-FM Radio Hofstra University invite you inside the Z-Suite.
Hello, I'm Janet Lenihan, Dean of the Frank G. Zarb School of Business at Hofstra University. Welcome to Inside the Z-Suite, featuring current topics and talks with business leaders across every industry. Over the past decade, you may have found yourself among the growing crowd of U.S. firms and taxpayers finding it more challenging to hire a qualified accountant for tax preparation and financial advice. In fact, our nation has seen a reduction of approximately 340,000 accountants in our workforce, a decline that includes individuals seeking an accounting degree and passing the CPA exam. Joining us today to discuss the current issues in accountancy and the path forward is Jeffrey Weiner, former chair and chief executive officer of Marcum LLP, now CBIZ, a top-ranked national accounting and advisory services firm dedicated to helping entrepreneurial, middle-market companies, and high-net-worth individuals achieve their goals. Jeff currently serves as chair and CEO of Integrity Automotive. With a career spanning over 40 years, Jeff has become a nationally recognized expert in personal business management for the entertainment industry. A graduate of Hofstra University's Zarb School of Business and a recipient of the university's prestigious Alumni Achievement Award, he maintains strong ties to his alma mater through his service on the Dean's Advisory Board. As part of that connection, Jeff was the driving force behind the partnership between Marcum and Hofstra, which led to the launch of the nationally recognized Marcum Hofstra CEO Survey, a quarterly report offering valuable insights into the business environment, outlook, and trends among middle market CEOs. Jeff is also a founding member of LEA Global, one of the world's largest accounting associations, and has been honored with the Long Island Business News Icon Award. Jeff, it's a pleasure to welcome you back to campus and to Inside the Z-Suite.
Well, thanks, Janet. It's great to be here.
Let's begin by exploring your journey into the accounting profession and your path to becoming a CEO. Looking back, what inspired you to enter the accounting profession? And how did your early experiences influence your leadership style and approach to driving business growth?
I don't know if it was inspiration or need. I grew up on Long Island, actually North Massapequa. When I came to Hofstra, it was on a commuter basis. I worked my way through school. I knew after 4 years I had to join the workforce. Hofstra's business school and accounting program back then was as well regarded, if not more so, than it is today. Accounting seemed like a good background to eventually go into a business. So it was as simple as that.
Well, they always say, right, accounting is the language of business.
It is. You know, in my years at Hofstra, I got a great education. In my senior year, I watched the other kids I was going to school with start doing on-campus interviewing for Big 8 firms at the time. Now they're the Big 4. Being as competitive as I am, I said, well, if they can do it, I can do it. Had job offers from 2 of the Big 8 at the time, picked one. The rest, as they say, is history.
How did you get to Marcum?
My first 2 years I spent at Deloitte, courtesy of the Hofstra placement service and on-campus interviewing. I realized at the time that Big 8 accounting wasn't for me. My first year salary in 1979 was $14,500 a year. The world has changed since then.
It was a lot of money then.
It was, and I worked really hard. I've always been a hard worker, and I thought I did pretty well. And I came to my first year anniversary and went in for my review, and my increase from $14,500 was to $15,300. So I looked in the mirror and I said, I worked my butt off for a year and I get an $800 increase. And after taxes, if you figure it out, I think it was $40 or $50 a week. And I said, this Big 8, this corporate environment is not for me. I served my 2 years. Back then, to become a CPA, you needed 120 credits, not 150. So it was a 4-year degree and 2 years of experience. So I figured I'd serve my 2 years at Deloitte. And then, having grown up on Long Island, I went and found the smallest accounting firm I could find. Marcum at the time was called Marcum and Kliegman. It was based in Syosset, and there were 6 people working there. And I figured if I didn't like the big firm environment, let me try the small firm environment.
That's amazing. How was the different experiences in those two firms? How did it shape you as a leader?
It was night and day. At Deloitte, I forget how many people they had there, but there was no leadership opportunity as a first or second year accountant. When I went to Markham, it was a firm of 6 people, which had 2 partners, both who were in their, I think, early 60s or maybe late 50s. I saw the opportunity at some point that if it worked out, that they would be retiring at some point, and there could be an opportunity to take over a leadership position in that firm.
And boy, did you take advantage of that.
Well, it seems to have worked out.
But before we get there, I want to talk a little bit more broadly about just the accounting profession. You know, it's gone through just transformative changes over the past few decades, from tech disruption to changes in talent expectations. And so from your vantage point, what do you think have been the most defining changes in the profession that you've witnessed? And how do you think firms are adapting to meet those challenges?
I would say certainly technology has been at the forefront of change. I remember when I started in the industry, we actually worked with pencil and paper. We didn't have computers. I can remember back to 1984, I'm dating myself, when Markham brought our first IBM PC.
And that was a big deal, right?
That was revolutionary at the time. And technology has not stopped innovating ever since. From PCs to laptops to AI today, but we had bots and things like that before. Digital scanning, email. Email didn't exist. Computer networks, cell phones. The internet. None of these things existed in 1979 when I graduated from Hofstra. So technology has really been at the forefront of the accounting profession as well as most other professions and industries as well.
Let's talk a little bit about AI because obviously it's on everyone's mind. You know, there's the belief that either, your job is going to be replaced by AI, or there's others that say that's not going to happen. You'll be replaced by someone who knows how to use AI to do the job better. How is it going to impact the future of the accounting profession, both from the auditing standpoint and from the advisory practice?
I think technology, I'm going to put AI in the technology basket. Technology has enabled us to spend less time doing what I'll call detail work, ticking and tying, and more time thinking. AI, as well as everything else that came before it, has been a tool used by the accounting profession and will continue to be. If you look at the accounting profession over the last 40 or 50 years, there aren't fewer people in the profession. There are more. The profession has grown. The client expectations and demands have become greater. There's an insatiable demand for accounting services. There's not enough people to do it. So the more of the routine rote things you can get technology to help you with, the more time you have to think and advise and help your clients rather than just ticking and tying and making sure their books add up.
So let's talk a little bit about that shortage of accountants. And I mean, we're seeing that, you really can't pick up an article anymore about the profession without them talking about the pipeline issue and the shortage of the pipeline issue. I'm sure there's lots of factors that have contributed to that decline. What do you think is the most significant?
The most significant is the demand for the services and the demand for services. For the last 50 years, there's been a shortage of accountants. Now, are there times based on, economic times where that may change slightly? But if you look at a graph from 1979, when I graduated, there are more people in accounting. There are more jobs. The type of services accounting firms offer has changed in that time. So ever since I've been in the profession, there's been a shortage of accountants. There's never been enough. But the difference is there's a whole lot of professions that exist today that didn't exist 40 or 50 years ago. So the population hasn't grown that dramatically. So now today, kids coming out of a school like Hofstra's Business School have a lot more career options than they did in 1979.
So let's talk a little bit more about the shortage that you mentioned and how can the profession attract talent? Because you're absolutely right. Students do have lots of choices. And of course, part of that conversation has really centered around this 150 credit hour rule to sit for the CPA. As you know, there are many states now have looked to create alternative pathways to the CPA exam. Some are saying, what is old is new again, and they're looking towards more like an undergraduate degree and 2 years experience, similar to probably what you needed when you sat for the CPA exam. And so I'm just curious, there is a lot of debate in the profession about this. What do you think? What are the issues on both sides? Is it making these alternative pathways will help strike the right balance between keeping the professional standards and broadening access? Or is it going to miss the mark and not really impact the pipeline issue?
You're asking a lot of questions all in one. So let me start first with the accounting profession. I don't think the accounting profession does a great job marketing itself. Accounting is not marketed as an interesting or sexy profession. It's got this green eye shade, curmudgeon-y reputation, which is the farthest thing from the truth. Pencil protectors, or pocket protectors. Yeah. It's the furthest thing from the truth. So I think the accounting industry really has to get the right marketing consultant to make it look like the accounting profession is as interesting as it is. We do a terrible job sending out that message. The 150-hour requirement, I can give you arguments on both sides. First of all, you can't be any other kind of professional, doctor, lawyer, teacher, with a 120-hour degree, with a 4-year degree. So accounting is not that different from most other, I'll call it white-collar professions. If you want to be a teacher, you need a master's. If you want to be a lawyer, you need to go to 3 years of law school. You want to be a doctor, you need an undergraduate degree, you need 4 years of medical school. You most likely go for a residency. You're in school for 12 years or so. Still at 5 years or 150 credits, accounting is on the low side. Back when I started, if you wanted to be licensed in New York, you needed to pass the CPA exam in New York, get a New York license. If you wanted a license in another state, you had to register. You potentially had to take exams there. There wasn't mobility that we have today. So today, in virtually every state, your CPA license is like a driver's license. You can go from state to state and practice as long as you obey that state's rules. And there's some caveats to all of this. But with all the states being on the same standard of 150 hours, you can have mobility. If the states start changing and now they have different requirements to sit for the CPA exam, you may lose mobility. At one point, I was licensed in, I think, 15 different states that Markham did business in because somebody had to be licensed. That was 30 years ago. With the advent of 150 hours and every state being on the same standard, they created this mobility, so your CPA license was in essence the same as a driver's license. So none of these answers are easy, and it's real easy to say go back to 120 hours. You can sit for the exam with 120 hours. So a lot of kids sit for the exam before they finish their 5th year. There's a whole lot of ways to go from 4 years at 120 credits to 150 credits. You don't have to do that all as a 5th year undergrad. You can do that at night or however you want to do it. I don't think it's necessarily a bad thing. I think it all goes back to marketing.
Interesting. That's really interesting. I mean, certainly, the nursing profession had a similar issue. And I can recall when they actually did, as a profession, did exactly what you're suggesting the accounting profession do. Hire a marketing firm and start really talking about what it means to be an accountant. So if the industry isn't willing to do that, what can individual firms do? In other words, so how do the big four, but more importantly, how do the mid-majors compete for talent and attract new talent?
Marketing has become common in accounting. We all have websites. We all have HR departments that do campus recruiting and recruiting for experienced hires. So we're marketing to college grads on campus, the same as the big four do at this point. More importantly, we're marketing to people who are switching jobs after their first job. Back when I started, you could not go to a big 8 firm if you didn't start there out of college. So if you wanted a Big 8 job, you had to go out of school. The Big 8 would never hire somebody from a small accounting firm. Today, there's no rules. 40 years ago, if we saw the resume of somebody who switched jobs every 2 years, we saw that as a warning sign. Today, it's commonplace. It's more prevalent than not that people we're hiring have spent 2 years, if that much. There's a lot more mobility. There's a lot more flexibility. And it's not a mark on your resume. It's what people expect to see. It's highly unusual for people today graduating college to have their first job 10 years later.
Absolutely. As a CEO, how do you navigate that in terms of culture? In essence, you're constantly planning for onboarding talent and developing new talent. How do you create that culture that's so critically important?
Well, it's the people who stay, who really buy into the culture, live the culture, and pass it down to the people we're hiring. But at Markham, when we sold last year, we were about 4,000 people. We were hiring out of college 200 kids a year. 5 years later, of those 200 kids, maybe 20 were with us. At the 5-year mark, maybe we had a 10% retention rate. But accounting is a cycle business. So you have your busy times and you have your not busy times. So I would tell you the average accounting firm, whether they admit it or not, probably has a 15 to 20% annual turnover rate between hiring new kids out of college. That's about 5% of your new hires. People you let go after busy season. We at Markham subscribe to the Jack Welch theory of A, Bs, and Cs. After traditional busy season, we would weed out the C players, because not everybody fits at every job. And then in anticipation of the next busy season, we would then gear up, try and replace the C players with people who we thought was better. And then you have to factor in growth. We were hiring, when I left, somewhere between 500 and 800 new people a year. You really have to have an HR team that is up to the task. You also have to have a reputation of being a firm people want to work at. People look for different things today. They look for how progressive you are in technology. It's a big key. They look for ways they can give back for the community. At Markham, we had a charitable foundation. They want to see a firm that not only works hard, but realizes they can have a social impact and things like that. They want flexibility. COVID taught us that people could work not only in an office, but they could work remotely. So we had people at Markham who had every type of work arrangement you could imagine, from fully in the office, 60 hours a week, to people who never showed up at an office, and everything in between. Over the years, we just had to adapt to whatever was going on socially and economically. And that's what people look for.
Which is definitely attributes to your growth, right? And your success, that you were able to adapt. So many companies can't do that.
I don't know if they can't, or they don't want to, or they don't realize they have to. But unless you adapt, you're in trouble. No business today is operating the way they did 40 years ago. Certainly 40 years ago. The workforce has changed. Technology has changed. Communication has changed.
Yeah, absolutely. You had talked about kind of the work-life balance that new talent is expecting. And that's really important, because some actually attribute the decline in the number of accountants in the pipeline because that's a negative for them, that they feel that there's a lot of hours and the compensation isn't where it should be, and so therefore they should go become investment bankers if they're going to work that much and get paid more. How did you create work-life balance when you have such a demand for your services? I'm sure you had lots of things you needed to get done.
2 part-time people add up to 1 full-time person. So if you're expecting people to work 50 hours a week, you're not going to be able to find only people who work 50 hours a week. But if you could find 2 people to work 25 hours a week, you've solved that problem. You have to be creative. You have to be flexible. Not everybody who comes into accounting wants to be a partner in an accounting firm. Some people just want it to be a really good job with good pay and good benefits and a good place to work, where they're respected for the fact that they want to work 20 hours a week or 30 hours a week, or they want to work remotely half the time. This is the way the world is in 2025. Not everybody is open-minded. Not everybody is flexible. People think people running businesses think it's all about them. At some point, while the inmates don't run the asylum, you really have to cater to their individual needs.
That's interesting, right? Because we're seeing a lot of debate about remote work. I mean, certainly in the banking industry, of one major CEO of a bank who said everybody back, or, find a new job. And another one said, hey, come to me. So you're right. It's definitely something that different CEOs see differently.
Yeah, and I'm not sure in a company it's one size fits all. There are certain jobs that clearly can't be done remotely. There are other jobs that can be done 100% remotely. But I think you have to talk to people. I would do town hall calls. I would write a weekly column called Thoughts of the Week. Through COVID and after COVID, I started focusing on showing up. I will tell you, people don't like to talk about it, but clearly showing up and having the people you work for know you by name and face and what you do does give you an advantage. You should know that, and then make an informed decision whether you just want to be an employee without the same career path. You may think it sounds unfair, but showing up is part of it. I have a son who's a commercial banker. He's 30 years old, works for TD Bank. when he got his banking job, and he likes the banking because it's less pressure than an accounting job or something like that. It's very predictable hours. His name is Leo. And I said, Leo, I'll give you 3 pieces of advice that will help your career be different than the people you work with. I said, first, be the first one in every day. Be the last one out. And whatever they ask you to do more. Those are 3 pieces of advice I've given anybody who's asked, and people who haven't asked, by the way.
It's great advice.
During COVID, I added a 4th because of what we all went through, and the 4th thing I added to that was show up. If you take those 4 simple rules, no matter what you do, first one in, last one out, whatever they ask you to do more, and show up. I don't care whether you drive a bus or you're a lawyer or an accountant, a nurse, anything. The people you work for notice those efforts. They notice the extras. In evaluating people, if they know who you are, they know your name, they know your face, they know you're in early, you leave late, you're not watching the clock, you're always exceeding their expectations, you're going to have a great career path. You can't confuse people who want that with people who don't. And if you want that, these are 4 really simple rules. If you're not willing to do that, admit to yourself, like, hey, I just want a job for whatever reason. I'd rather more free time than work. I could have a family and I want to spend more time at home with my kids. Whatever it is, realize your own desires, realize your own potential, and don't compare yourself to people who are doing it differently.
It's fantastic advice, really, really great advice. But I want to take a little bit of a pivot, although I'll come back to that. Just talk a little bit more about the profession, because another interesting, I would say, aspect of the profession that's relatively new, right, maybe over the last decade or so, is the influx of private equity. Most recent one that got a lot of press was Grant Thornton. I would love to get your thoughts on how do you view this trend? Is it something that you really feel is a much-needed growth catalyst and therefore advantageous to the profession, or are you concerned about its impact on the profession's independence and culture?
I've been saying for years that the public accounting business model was antiquated. And public accounting has recently gone through the change that happened to Wall Street about 25 years ago. If you remember back that far, you and I can remember back that far, there was a time when companies like Merrill Lynch and Morgan Stanley and Goldman Sachs were partnerships. They weren't big public companies. They realized 25 years ago that being able to access investment capital from outsiders could help their businesses grow. Nobody's gotten poorer watching Wall Street go from being private partnerships to public companies. So private equity came into the accounting profession in 2021, 4 years ago. It was the first time there's a firm called Eisner-Amper, run by a friend of mine named Charlie Weinstein, who cracked the code and figured out how to take a private equity investment into an accounting firm. And that really set the stage for what you have here today. The old accounting model of public accounting was antiquated. We could not raise outside capital. So the only way that you would have capital in a firm was the partners either putting money in or leaving money in the firm that they could otherwise take out as compensation. That's number one. Number two, you had this title called partner. While it sounds nice, not all partners are created equally. People thought you got to be a partner in an accounting firm, and that was the end-all and be-all. It really was a bad business model. By being able to take in private equity, now it's not solely the partners who are capitalizing the firm. There's outside capital. Outside capital creates a valuation. It used to be that if I wanted to retire before private equity came in, I could only get deferred compensation, or what we would call a pension. I'd get a percentage of my earnings for a fixed amount of time, and that's what I got. But the firm itself had no value. All of a sudden, accounting firms were valued on an EBITDA basis, just like every other business you've ever heard of. Our compensation went down. Now we have this equity, we have this stock ownership of something that somebody has monetized and put a value on it. When Eisner-Amper did their deal in 2021, accounting firms were valued at 10 times EBITDA. The latest firms to trade are in the 15 times EBITDA valuation range.
It's incredible growth.
Yeah, I would say today 10 of the top 25 firms are either PE-backed, or as in the case with Markham, last year we sold to a company called CBIZ. CBIZ is public. It's the only publicly traded accounting firm in the country, and they've been public for 25 years. The PE firms that are coming into accounting, their eventual exit will be some type of public offering. So I would say if we're sitting here 5 years from now, there won't be one public accounting firm, but there could be 5 to 10 of them. I think it's a natural evolution of the business, which took a long time to get there. When you get to independence, I don't see why the ownership structure should impact independence. There are rules. Even without being PE backed, there was always cases where you didn't have independence. You couldn't take out a client or you had to resign from the client. The bringing in outside capital complicates that, but it's manageable. And any client where you can't do work because of an independence issue, there's a whole lot more clients out there that you can do work for. Even over the last 45 years, we've always had clients we've either couldn't take or had to resign from because of independence issues. That shouldn't change with outside capital coming into the industry.
It's really fascinating to watch. It's going to be a business case, right?
It is, and it all goes back to, if you believe like I do, that the business model was antiquated. It's, again, the same way technology has changed things and work-life balance has changed things and the things people want when they come to work. It's the business model has changed. And if you want this afternoon, you can go buy CBIZ stock and invest in an accounting firm. A couple of years ago, it's an interesting story. As the workforce has changed, we would bring in, people would come to work for us. Those who stayed for the 10 years or so, we'd make them partners. There were two types of partners in accounting firm, equity partners and non-equity partners. Equity partners own the company. Non-equity partners get the title but don't have any ownership interest. And usually if you were promoting someone from the staff, their first stop would be non-equity partner. And that was easy. They got the title. They got to, go out in the world as a partner, and we see how they developed. When we wanted to make them an equity partner, now it came time for them to actually put up some money to own part of the firm. It wasn't a lot of money. If they didn't have it, we had a bank that would lend it to them, and it was painless. But then we had the deferred compensation. So you're making these equity partners 32, 33, 34 years old. Most accounting firms have a deferred compensation plan that lets you retire sometime after age 60. You go talk to a 35-year-old today about being with you 25 years from now, and they look at you like you're crazy.
Yes, they do.
It's different than when I went to school. I didn't know any better. Today, people have options. So they look at their friends who work for private equity firms. They look at their firms who work for public companies. They look at their friends who work for startups. And today, people are looking for monetization events more frequently than working from 22 to 60 or 65 and then retiring with a pension. They want some type of monetization event every 5 years. They don't want to wait to the end. With the capital stack changing in accounting firms and being able to take on outside capital, you can offer those people very good compensation, maybe not as much as if we owned it without outside investors. But on the other hand, there can be monetization events every 3 to 7 years, whether that's selling from one PE firm to another, whether that's increasing the EBITDA and refinancing debt and paying out a dividend, whether that's going public. Kids today, this is not a bad thing, kids today want to see monetization events. They want stock, they want options, they want more than just cash compensation, and they want the opportunity to cash out something every 3 to 7 years. So maybe the first time they do it, they buy their house. Maybe the second time they do it, they buy their Porsche. Maybe the third time they do it, they buy their beach house. They don't want to wait till they retire to see gold at the end of the rainbow.
That is so fascinating, and it may actually help answer the pipeline issue because it'll become more attractive to young talent to get into the profession. Really fascinating. And I could keep going, but I know we are probably at time, and it's the moment in the interview here at Inside the Z-Suite that I get to ask you some fun questions just off the top of your head type of answers.
Go ahead.
All right. You ready?
Ready.
Here we go. If you could trade places with anyone or anything, who or what would it be?
Oh, probably my dog.
It's a good life, right?
It is a great life.
That's great. What is your favorite household chore?
Oh, that's interesting. I actually do a lot around the house. We have 2 dogs I take care of. I fill the dishwasher. I empty the dishwasher. I love food shopping, by the way. My wife hates supermarkets, and I love going food shopping.
Are you very cost conscious? Is the accountant in you come out?
Not at all. Zero. And as a matter of fact, I usually come home with much more than I went for.
And then you get in trouble.
I don't know about that, but I don't mind food shopping. I don't mind errands. I like errands.
Okay, that's great. So what's your least favorite household chore?
Taking out the garbage.
Yes, and it's always there.
It's always there. We manufacture garbage.
That is very true. Very true. All right, final question. And you've really already given the students who are listening such great advice about being the first one in, being the last one to leave, showing up, always saying yes. Is there any other, in your mind, key to success that you want to share?
Yeah, do something you like. You can be successful in a profession. You can be successful in a trade. You could be successful in the arts. Do something you like. Have a passion. If you get up in the morning and whatever we call work is something you're passionate about, it's not work. I never thought I was at work. I really loved what I did. I got a lot of pleasure out of building Markham from where it started to where we wound up. But it wasn't work to me. It was an extension of who I was. So you have to have a passion. And when you have a passion, it doesn't seem like work.
That is such great advice, Jeff. Thank you so much for being here today and for the great advice that you shared, and also just telling us about your insights into the accounting world, including ways to rejuvenate the workforce with innovative training and staffing approaches while integrating new technology into professional practice. Thanks also to our show's producer, Adrian Stoller, and WRHU audio engineer, John Mullen, for their support. Be sure to tune in weekly on the radio and online to WRHU 88.7 FM, Hofstra University, for a new episode of Inside the Z-Suite, or catch up with our show wherever you enjoy your podcasts. For more information about this program and the Zarb School of Business, please visit hofstra.edu/business. Until next time, I'm Janet Lenihan from Inside the Z-Suite.